So cost of term loan, 20% into that, you will end up with 14%. Take it to your table. Cost of term loan is 14%. Write it. We go to debentures. Carefully guide the examiner what you are doing. Working either for or whatever cost of debenture. In bracket KD. When it comes to a debenture, ask yourself, is it redeemable? Or is it irredeemable? This is where the examiner will catch you. Once you discover the bond or debenture is redeemable, the cost of the bond, let me use B, debenture, could use D, is always IRR adjusted for tax. But the day you find it is irredeemable, the cost of that debenture or bond is the cash flow. At this point, we adjust it for tax divided by market price. Of course, you multiply it by 100 to make it sweeter. Now, when you go back up here on the preference share, I did indicate for preference share, the approach is the same, but I did not adjust the cash flows or the IRR for tax. Because for preference share, you are paid dividends after appropriation of tax. I mean, from profit after tax. But for a debenture, the interest expense is tax deductible. That's why you see in the last case question, they are also asking you, what are the advantages of debt over equity? Therefore, we are going to go through the case and check our debenture. Is it redeemable? Now, the debenture is carefully indicated that the debenture is irredeemable with a par value of 1,000. Write that. So, we have been told debenture is irredeemable. Since this debenture is irredeemable, they are further telling us the par value of the debenture is shillings 100. Granted. Go slow here, but currently quoted at a discount. That means the market price of that debenture, market price of the debenture is at a discount of 5%. This means you're gonna pick the par value, multiply it by 95%. 100% minus 5%, you will end up with shillings 95. What is the coupon rate? The coupon rate of the debenture, we go and look for it. The coupon rate in the extract is 15%. Therefore, it is 15%. Please get reminded, this is always per annum. But when you read the case, we are being told, while the interest is payable semi-annually, okay, interest is paid semi-annually, meaning we are compounding twice a year. Therefore, our cash flow, which is always the coupon rate, the coupon interest, you multiply it by par value. The coupon rate is 15% per annum. You divide it by 2 to convert it into semi-annual, then you multiply by 100, the par value. And when you do that, you'll be able to get at times the mistakes are done somewhere in the marking guides, but with you continue doing the right thing, so you'll get 7.5% times 100. So this is 7.5%. You multiply by 100, and you will end up with shillings 7.5. Therefore, the cost of the debenture is the cash flow adjusted for tax. So it will be shillings 7.5 into 1 minus 0.3 divided by the market price. The market price of this debenture, we got it as shillings 95. You divide it by shillings 95. And of course, you'll multiply by 100 to make it a percent. And when you throw that into a calculator, times 0.3, 0.7, divide it by 95 times 100, you will get the cost of debt of the debenture as 5.5%. Let me check it again. 7.5 times 0.7 divided by 95 times 100. That is it. Take it to your table. The cost of the debenture is 5.5%. At that stage, I'm looking for work. I can type it here. Work is going to be, you multiply these two figures, the 25, the proportion. So I'm going to multiply the two, the proportion, you multiply it with the specific cost in that direction, and you continue doing the same for all. You continue doing for preference the proportion, you multiply it by, continue doing the same, the cost of the proportion times that, pick the proportion, you multiply it by, and therefore work is the sum, the total of those figures. Can reduce the decimal places. So that should have been our work the examiner wanted. You come out of the table and make a comment. You lose a mark for not commenting. And you will say the weighted average cost of capital is 12.9%. Full stop. Don't write much. The examiner will feel happy. So in this case, we observe the amounts were not given. The amounts always help you to get the proportion. But in this case, the proportion was provided, and that was the concern. We continue. Part B of the question, evaluate the viability of the proposed investment using the profitability index. Earlier, we had started well. When I carefully indicated it to you, we go back and recap. We go back and recap and carefully indicated to you that profitability index, you will need to identify relevant cash flows, and you can use the first one, sum of PVs of cash inflows divided by the sum of PVs of cash outflows, which is the same as 1 plus NPV of that. So you will need to compute the NPV. Therefore, I'm going to look at part 2. And in part B of the question of our mock was evaluation of the project using profitability index. I'm aware I will need to lay out my NPV. So I will put here. Earlier, they had told us the project is 5 years. And then I go and look at the workings. So we go and read. This requires to go back from where we started. As a strategy to increase its regional presence, drive sales, and ultimately increase profit levels of the company, management is considering acquiring 10 new delivery vans at $47,000. And therefore, we do that is a working one for that part. We are looking at evaluation of the project using a profitability index. So part B, we are looking at evaluation of the project using profitability index. And we need to identify relevant cash flows. But our working number one According to that, we're going to look for the initial cost, or known as outlay. They are talking about delivery vans. These delivery vans, they are 10 vans, each at $47. But a dollar is being quoted at shillings 3,700. So when you multiply that, you should be able to get UGX. And you multiply that, the cost of the vans should be able to be UGX 1 billion point something 39. You will get a mark for that. We continue. So we are done with, we have taken the exchange rate, we have taken the 10 vans, but there is 5 years we have taken that, but they are telling us the scrap value. Write it down. Working to scrap. We have been told scrap is 20% of initial cost. And the initial cost is 179. We have it up here. 13139. When you multiply that, you will get UGX 348. You continue reading the case. So we have sorted out the scrap. Now we are going to annual revenue. The annual revenue, we are being told the annual revenue is 12 billion, 12.5 billion. Their current annual revenue is that, but when they acquire new delivery funds, this is expected to increase by 40% in the first year of the operation. That means, can you go and do a working? Working 3. And we are looking at annual revenue. So they are telling us in the first year, can set up a smaller table. I will have the year. I will leave a bigger space where I will be able to calculate. And at the end of the day, I will be able to get my relevant revenue. Because there's some revenue there, I will put year 0. And that current revenue is 12.00 million. I will have nothing there. I'm just planning my solution. So for year 1, the revenue will increase by 25%. So I will get 12,000 million multiplied by 25%. When you multiply that, you will get 300 million. Or someone could have first increased. Or I will squeeze it here. Someone could have said 12,000 times 1.25, you are likely to get 12,300. But 12,300 is not relevant. It has increased. So you need to take off the other 1200 to get the 300. Now, when we go to read the equation, we have plugged in. No, I'm wrong. The annual is expected to increase revenue by 40% in the first year. Sorry, it is 40%. We need to rub off that and do 40%. So I'm going to multiply by 40%. And when I do that, I get 5,000. That's the same as looking at it. Once someone could have said it is 12,000, you first increase it, you multiply it by 1.4. When you increase that, let me increase it here. 1200 times 1.4. I'm making a mistake. The revenue was 12.5. I had written this on my notebook here. It is 12.5. Just correct that. This should be 12,500. $12,500 million. And therefore, when you come here, you'll have 12,500 times 40%. That's when you get that. Or it could be someone could have first increased 12,500. You multiply by 1.40. You get, I'll put here or, just to show you that you get the same answer as an alternative. So let me put it on a calculator. 12,500 times 1.40. You will get 17,500. So when you subtract off that figure, which is not relevant, you will get 5,000. But wait a minute. We are told the relevant annual revenue will subsequently increase by 10% effective year 2 until year 4. It means when I come to year 2, the relevant revenue is 5,000. So in year 2, I will have 5,000. I will increase it by 10% and I will get 5,500. And in year 3, I will have 5,500, increase it. I will be able to get 6,050. We go back and read. Go back and read the case. The 10% is effective year 2 up to the beginning of year 4, when the expected will decline by, read the word, decline by. So in year 4, we are declining. So in year 4, we are going to get the 6,050. We are declining by. So we multiply by 92%. You end up with 5,566. But the project is 5 years. So in year 5, the decline continues. Bring 5, 5, 6, 6. You multiply by 92%. And you end up getting 5, 1, 2, 1. That is our revenue. That is our revenue. So if you go back to the case, we have been told we are up or have stopped here. Mr. Mhumuza, the finance manager, has indicated that the proposed capital investment will result into additional annual variable cost of 70%. I don't need the working for that. When I go to my table, I will be able to do that. He has further revealed that the investment will necessitate additional working capital estimated at 10% of the initial outlay in the initial year of the investment. Then we start increasing it. So we go and do that working capital, and apply the rules. So working, let me confirm the working for. So working for, we are looking at working capital. A working capital at MAT Abacus, we use a small table, which usually have the year, the required, then the movement. Yesterday we were sharing the movement. If you don't want the word movement, you use the increase. So I will draw my table. That's how we do it at MAT Abacus. We have been told you can start from year 0 or you can start from, but at MAT Abacus, Visual Assembly, the project has 5 years, so you lay your years, starting with year 0, year 1, year 2, year 3, year 4, year 5. If you start laying your data in the required is as per the English in the question, we have been told we are going to get 10% of the initial investment, which is that. The answer remains in the same box, which is 174. 179, sorry. 179. Then it will begin increasing by 10% according to that question. So you will have 179 times 1.10. When you increase that, let me pick my calculator. 179 times 1.1, you will get 196. You will get 196. When I round off, I get 197. 1739 times 10%. Sorry, this is not right. This is not right. When I check and round off, I will have 174. It is 174 when you round off. So this is 174. And when you increase, you will get 191 here. The process of increasing continues. 191 times 1.10. You will be able to get to 10. And you'll bring your 210 here, increase it by 1.10. When increasing by it, you will get 23. And in year 4, you'll have your 231, increase it by 1.10. When you increase that, you'll get 243. Because we started in year 0, in year 5, we have no business apart from recouping. You recoup. Recouping is the same as recovery. But just to confirm whether we are right, read again. Working capital, investment in working capital, estimated at 10%. We have done that in the initial year, increasing by 10% in each of the subsequent years until the beginning of year 4, when it is expected to increase by 5% until the beginning of year 4. So we need to correct something in year 4. Year 4, we are not growing. We are increasing by 5%. So this will be 1.05. Let me check that on a calculator. 231 times 1.05. You will be able to get when I round off, I will get what? I will get 243. What you take to your NPV table is the movement. This working capital in year 0, it means it is the initial one you inject. I will put it in negative to mean that you are injecting, you are incurring working capital, and then we shall recognize working capital if it is increasing. So you can see we are moving from 174 to 191. That means there's an increase of 17. And working capital continues to increase. It means there is an increase. You have to inject 19. 210, when you get the difference, 210 minus that, and the process continues. When you move from 210, it increases to 231. That means you inject 21. And working capital continues to increase. You will further inject 12. I'm putting in negative to mean you're injecting. But in the final year, you recoup. You add up all those negatives, 174 plus 17 plus 19 plus 12 plus that one. You recouping it, the answer will be positive. You will end up getting 243. That will be recouping. That's how the figures will appear in your NPV table. Continue to conclude. We're about to conclude. So we are done with working capital. I think we are left with 2 more workings. There is this one. When you hear current annual fixed costs are 1.2, and the proposed investment is expected to increase this by 25% in year 1, we need to set it up. We need to set up that. So it is working 5. And our working 5, we are dealing with annual fixed costs. Shall we draw a table? shall have the year. I will leave a space here for details, and I will have relevant. This word is key, relevant fixed costs. That space will help you to do your workings there if need be. Because they're telling us there is something currently, the fixed cost in year 0, I need to recognize that is 1.2 billion. But they say in year 1, it will increase by 25%. So one can get the relevant will be that increase, which will be 12,000 million. You multiply by 25%. The answer you get will come directly here. That will be the relevant. Someone could have said, or you could have said it is 12,000. You multiply by 1.25. You'll end up with 1,500. Therefore, the increase is the difference between that figure and that, which is 300. Then you should be able to read and see how you are moving. The question says the relevant annual fixed costs will therefore increase by 8% in each of the years 2 and 3. So in year 2 and in year 3, we are increasing by 8%. So we are going to have the relevant, which is 300. We increase it by 8%. You'll end up getting 324. And in year 3, still increasing by 8%, you'll end up getting 350. What happens in year 4? What happens in year 5? Let us go and read. We had stopped here. Then later, by 15%. Mark that word by in each of the years 4 and 5. So in year 4, we are going up by 15%. So we shall bring the 350 here, multiply it by 1.5, representation of that increase. And when you do that, you get 402. And in year 5, you get 402. You continue growing it by that rate. And this working takes 3 marks. So you shouldn't lose it. You just need to be careful. If you wanted to write here something, you'd write here details. And when you're presenting your work, be clean enough. Use a ruler where need be. If you don't use a ruler, you will not be crossed. We continue reading. Question 1 is always rich. So we have reached here. There is opportunity cost, which we shall take into our table. There is no working. So now, as a way of increasing investors' confidence and encouraging investment in the country, tax authorities in Uganda have indicated that the proposed capital expenditure will qualify for annual capital allowance at the rate of 20%. Straight line. So we have to do a working. We have to do a working. So we need to do capital allowances. So it is working number 6. These workings, you get marks. So you come and write here, working 6. And we're looking for capital allowances. Commonly known as tax allowable depreciation. And this depreciation is abbreviated TAD. At MAT Abacus, we have a different approach. There are very many ways of dealing with this, but you end up with the same result. So I will do what we do at MAT Abacus. We usually set it up. We usually have the year. Possibly we can have the details where I will do my workings. And from there, I will be able to get my TAD. Remember, TAD is a straight line at 20% according to the equation. Then I will have my net book value. And then possibly I will have my tax relief. I'm looking for this tax relief. And the tax relief is at the tax rate 30%. And then I will conclude with the timing. That's how we do look at it at MAT Abacus. A premium in the institution. So in year 0, we usually recognize the cost. The cost was 1739 million. There is nothing there. Then we start. In year 1, you will get 20% of the net book value, 1739. And when you get 20% of 1739, let me get it. $17.39 times 20%. You will be able to get, if I round off, I will get 348. Then I will have my balance 173 minus 348. My balance will be 1391. Because I'm dealing with straight line, in year 2, the figure remains, the TAD remains as 348. I'm dealing with straight line. That's how we do it when you're dealing with a straight line. You maintain the TAD, but the balance will keep on dropping. This will drop to 1048. In year 3, the TAD is maintained. Wait a minute, that's not right. This is a 3. Let me subtract again. We are concluding 1391 minus 348, 348. You will get here 1043. When I subtract the 348, I will get 695. We are continuing. The asset is 5 years. In year 4, Still, I maintain the same TAD, but the balance drops. The balance drops to what? Subtract 695 minus 348. You will be left with 347. Now, our trouble is in the 5th year. You either look for a balancing charge or balancing allowance. In order to do that, you bring the scrap down here. We had scrap somewhere in our working, but I think that scrap was basically, let me get it, was 20 per. We had scrap somewhere. Can look for it. We had scrap somewhere. Our scrap is 348. So when I bring scrap here, the scrap coming through is 348. But because we've been rounding off, we seem to have lost a 1. And therefore, when I subtract, this is scrap. Just write, I'll write here scrap. So when you subtract these two numbers, when you look at these two, you get the difference. And therefore, the difference is, it's supposed to be the same. This should have been an 8, but the difference seems to be 1. And according to that, should have turned out to be a balancing charge, but may end up being immaterial. If we had not dropped the decimal points, we would have seen it balancing, but we continue. Now, when you are getting the tax relief, you will get this 348 multiplied by 30. You get 348 times 30. You get 104 point something, 104.4. You will get that relief. Because it is uniform, it will remain 104.4. 104.4, 104.4. But because we carried that 1, I want to see if it is material or what. So 1 times 30%, I will get 0.3, which is approximately 0. That 1, 30% of 1 is approximately 0. But because we have rounding differences, so how are we paying taxes? I do not know where the tax rate is, but if we carefully look at it, there was a tax rate somewhere. Either it was down here, and the tax rate is 30% payable in arrears. It would mean the first cash flow, you will claim it in year 1, in year 2. This will be claimed in year 3. This will be claimed in year 4, year 5, year 6. It means, therefore, when you're populating your table, you will include year 6. So I will add here year 6. And now we start populating our table. And this is your day. So I'll play for you some small music as I populate the table. Populating the table for you. We should be reminded that revenue, direct costs were 70% of revenue. So when you see that figure, do not get worried. It is simply 70%. And then we can get our contribution there. If you do know the standard that once you have revenue and you have got variable costs, contribution is revenue minus variable cost. So in year one, made a mistake here. Let me repeat, equals that figure times 70%. And if that is the case, that's what I will have. And my contribution is that. That is my contribution. Then you can bring the fixed costs. The fixed costs. These fixed costs, we worked them out. We had a negative 300, negative 324. We also had 350. We had minus 402, minus 463. We did not have another thing. Then we can get cash flows. Cash flows before tax. My cash flows before tax. I will get my contribution. I take off the fixed costs. And then I will charge my tax. The tax rate was at 30%. Now the tax rate being at 30%, taxes are in arrears. I'll write it here. but payable. In the exam, you will not write it there. Me, I'm writing it here because I'm really presenting. That means the tax of year 1 will be paid in year 2. That is very key. So you have to take note of that. That's what we shall have. That's why even we added on another year. We have year 6. Then you can get now cash flows after tax. Cash flows after tax. This is my cash flow after tax. These are the cash flows you'll be able to add on your, that's when now you can bring your initial outlay. Initial outlay or initial cost. It is always spent in year 0 in advance. You should bring your scrap. Scrap will go into year 5, not year 6. And our scrap was 348. It is a receipt. Then after that, you'll bring your tax relief. There was opportunity cost. The opportunity cost, if we go and read the case, there was opportunity cost. The opportunity cost is 0.35 billion. They didn't tell us when you will be able to get that opportunity cost. So you can take it to year 0. That is 350 million. Then we had working capital. Our working capital, we had negative 174, but it went on increasing. So I'm picking the figures from the workings. And finally, we recouped in the final year, which is year 5, not year 6. We had tax relief, tax saving on TAD. Remember, the first one goes into year 2. It was 104. And it is the same up to year 5. But in year 6, the last I approximated it to 0. And then we are done. Not yet fully done. You jump one line there to be neat, not mandatory. You get your cash flows, net cash flows. I will add them from that highlighted line. From there. And up to year 6, make sure you include year 6. Then you get your NPV. And the net NPV is the sum of those present values. That's what you get as your NPV. So this is your NPV. That is your NPV. So now we go and get the profitability index. I will do it on the journal. So finally, our profitability index, well, that's what they told us to do. Our profitability index, I'm going to use 1+. NPV divided by initial investment. We usually make mistakes here. NPV divided by initial investment. Okay, so I made an error here. I put NPV. We haven't gotten NPV. What we have are net cash flows. I was wondering how I quickly got that. This is not right. We haven't gotten the NPV. This is not right. The NPV is gotten by discounting the cash flows. So we're supposed to bring the discounting factor. The discounting factor must be at the cost of capital. In that question, we were not given the discounting factor. But if we recall, we computed our work as 12.9. 12.9 is approximately 13%. That's what we shall use. 12.9 is approximately 13%. So I will deal with that at 13%. So I will say at 13%. And when I discount those cash flows, I will get the discounting factor, which is, you read it from your table. But me, I'm going to use Excel to get them. I can reduce the decimal places since you are used to. So I will get the present value. And the present value is, you discount those cash flows. You have to make sure you include the final year. Therefore, your net present value will be the sum of those figures. So that is our net present value. So I will go and get my PI. Therefore, my PI, my profitability index, is going to be 1 plus the NPV I have, which is 1567. 1567. We divide by whatever falls in year 0, which is 2263. 2263. And when you work out that, you will find your profitability index. Your profitability index will be 1567. We are divided by 263. So it will be 1.6. And because it is 1.6, the question was, evaluate the financial viability using PI. You must comment. So you will come and comment because you get a mark for the comment, you should be able to say the profitability index of the project is 1.6, which is greater than 1. This means that the project is financially viable, and therefore it should be undertaken. If you are strong enough, you can add there QED. If you are strong enough. That's how you should have presented your solution. And you'd get your full marks. Part C, stages involved in capital budgeting. Every student would have gotten that. And therefore, it shouldn't have disturbed anybody. But when we're talking about stages involved, to garner the 5 marks, always, when we talk about stages, that's the logical framework. It is important we always determine the ultimate objective, the overall objective of what you're intending to do. So the logical process, part C of the question was talking about the logical process. The logical process in investment appraisal. This logical process is the same as stages involved. Always determine the overall objective of what you intended to do. This can be seen from the strategic plan. And normally you generate ideas, generate several, you generate ideas to enable you in generating several investment options. Once those ideas are generated, several options have been identified, then you carry out screening. Carry out screening or evaluation or appraisal of the investment options above. When the screening is done, then you need to look at selection of the best investment option. This is when you'll do screening using any of the appraisal tools, PI, NPV, IRR. Then you'll be able to make a decision. Once that decision has been taken, implementation begins. You need to carry out implementation of the selected option, investment option. And then finally, you carry out monitoring and evaluation, etc. That is always the logical framework, the logical process, the stages involved. That's what we wanted in part B, in part C of the question 5 marks. And the part D was about the stages involved in investment appraisal. And ladies and gentlemen, we have come to the end of this debrief. MAT Abacus wishes you success in the next coming examinations. Go out there and make us proud. Goefrey Karubanga is my name.